The tools that worked to address the crisis in 2008 won't work in 2025 because they've already been overused and everyone understands the potential consequences of using them again. For the average American with a 401k or IRA retirement account, watching their retirement savings decline by 60 to 70% will be devastating in ways that go far beyond just the raw numbers. Someone who spent 30 years diligently saving and has, say, $600,000 in their retirement account will watch it drop to $200,000 or less. That's not a mere market correction. That's the complete destruction of their financial future. They won't be able to retire. They'll have to work another 10 to 15 years, assuming they can even keep their job through the recession. For people who are already retired and depending on withdrawals from their investment portfolios to fund their living expenses, the situation is even more dire. They'll be forced to sell assets at the very bottom of the market to pay their bills, locking in losses that they'll never be able to recover from. The psychological impact of watching everything you've saved disappear before your eyes will be absolutely profound. In 2008, retirement accounts dropped significantly, but they recovered within about 5.5 years. Most people who held on to their investments eventually got back to even. In the coming crash, however, the recovery will take much longer, if it comes at all. Japan's stock market crashed in 1990 and didn't recover to those previous highs until 2024, a full 34 years later. An entire generation of Japanese investors never recovered their lost wealth. The same thing could easily happen in America if the crash is severe enough and the recovery takes decades. The destruction of housing wealth will trap millions of Americans in homes that they can't afford to sell. The job market for young people entering the workforce will be unbelievably brutal. College graduates in 2026 and 2027 will find that there are virtually no entry-level positions available. Companies simply won't be hiring. The few jobs that do exist will have hundreds of applicants competing for them. This generation will start their careers 5 to 10 years behind where they should be, significantly suppressing their lifetime earnings potential. Studies of people who graduated into the teeth of the 2008 recession showed that they earned less over their entire careers compared to people who graduated just a few years earlier. The coming crash will be even worse, meaning the economic scarring will be deeper and last much longer. Small businesses will be decimated as consumer spending collapses and credit becomes virtually unavailable. The local restaurant, the small retail shop, the family-owned service business, these will fail by the hundreds of thousands. Large corporations with access to capital markets will survive, albeit smaller and weaker. The economy that emerges from the crash will be even more dominated by massive corporations, with small businesses playing a significantly diminished role. This will reduce competition, innovation, and overall economic dynamism. Social safety nets will be strained beyond their breaking points as unemployment skyrockets and tax revenues collapse. The government will be caught between increasing demands for social services and a decreasing ability to fund those services. Spending cuts will become absolutely necessary even as more and more people desperately need help. This will create a humanitarian crisis on top of the economic crisis as vulnerable populations, the elderly, the disabled, and the unemployed, face reduced support at the very moment they need it the most. Political instability inevitably follows economic collapse. The 1930s saw the rise of extremist movements across Europe as economic desperation made people vulnerable to authoritarian promises. Weimar Germany's hyperinflation helped create the conditions that ultimately brought Hitler to power. The United States is not immune to the potential political consequences of an economic catastrophe. When people lose everything, they look for someone to blame and someone who promises radical solutions, no matter how dangerous. The 2025 crash will reshape American politics in ways that we simply can't predict right now, but that will likely be profoundly destabilizing. So, why is this potential crash in 2025 potentially worse than the combined crises of 1929 and 2008? Because we have the asset bubbles of 1929 in the stock market, the debt bubbles of 2008 in housing and credit, and a massive government debt bubble that didn't even exist in either of those previous crises. All three of these bubbles are bursting simultaneously. In 1929, only the stock market crashed, and only about 10% of Americans were directly affected. In 2008, the housing market crashed, but the government was able to borrow vast sums of money to bail out the banks, and the Federal Reserve could print money without triggering significant inflation. In 2025, everything is crashing together, and the tools that were used to fix things in the past simply won't work anymore. The Fed can't cut interest rates to zero because inflation is still stubbornly elevated. They can't print unlimited amounts of money because they just did that and caused the worst inflation in 40 years. The government can't bail everyone out because it's already drowning in over $36 trillion of debt. The 12 warning signs that I've outlined for you, from the inverted yield curve to Warren Buffett hoarding cash, aren't just speculation. They're demonstrable facts. They're happening right now. The inverted yield curve, which has accurately predicted every recession since 1950, is telling us that a recession is imminent within the next 3 to 9 months. Regional banks are already failing. Commercial real estate is collapsing. Consumer debt is at record highs, with delinquencies on the rise. Unemployment is starting to increase. Insider selling by corporate executives is at levels that historically precede major market crashes. Every single economic indicator is flashing red simultaneously. The timeline is fairly clear based on the yield curve normalizing in September of 2024. Recessions typically follow a yield curve normalization within 3 to 12 months. That puts us squarely in the window of December 2025 through September 2026. Commercial mortgage refinancing activity peaks in 2025 and 2026. Credit card defaults are accelerating right now. The trigger for the crash could come at any moment, and once it starts, the resulting economic cascade will be completely unstoppable. This isn't just a prediction, it's pattern recognition. The same patterns that preceded the crashes of 1929 and 2008 are clearly present today, only in a more extreme and amplified form. When the crash finally arrives, stock prices will drop by 65 to 80% from their peak, even worse than the 89% drop experienced in 1929 because it will be faster and more concentrated. Bonds will drop by 35 to 50%, something that didn't happen in previous crashes. Real estate values will drop by 40 to 60%, even worse than the decline seen in 2008. Unemployment will exceed 15%. And the recovery will take not just 5 years, like after 2008, but 10 to 20 years or more because the Federal Reserve has essentially run out of tools, and the government has no remaining borrowing capacity. This everything bubble has earned its name because everything will crash together and there will be nowhere left to hide. Those market crashes that we read about in history books, the ones we thought could never happen again because we learned from the past, are about to repeat themselves with a violence and on a scale that will shock everyone who still believes that it can't happen. The cold, hard mathematics of unpayable debt, overvalued assets, and exhausted policy tools guarantees it. The crash is coming. The only question that remains is whether you'll be adequately prepared when it arrives. In 1929, the American economy took a nosedive with a stock market crash, plunging the nation into the Great Depression. Over the next 3 years, stocks plummeted by a staggering 89%. Unemployment soared to 25%, a quarter of the workforce without jobs. Banks buckled under the pressure, and people's life savings vanished. It took a grueling 25 years for the market to claw its way back to the levels it had reached in 1929. Then, in 2008, history seemed to repeat itself as the housing market collapsed, triggering the Great Recession. Stocks plunged 57% in just 18 months, and unemployment climbed to 10%. Banks teetered on the brink of collapse and required massive government bailouts. Retirement accounts were decimated, leaving many with little to nothing. This time, it took 5 years for the markets to recover. But the situation facing us in 2025 is different, and frankly, far more alarming. We're not just dealing with one sector in trouble. Stocks, bonds, and real estate are all simultaneously crashing in what financial historians are ominously calling the everything bubble. And the terrifying reality is that when everything crashes together, there's simply nowhere to run, nowhere to hide your money. What if I were to tell you that this isn't some unprecedented event, but rather a chilling replay of 1928, the year right before the Great Depression hit? Except this time, the circumstances are far more dire because the very tools that we used to pull ourselves out of the crises of 1929 and 2008 are no longer available to us. The Federal Reserve can't slash interest rates to zero because they're already scraping the bottom. They can't just print unlimited amounts of money because they already tried that, and it resulted in the worst inflation we've seen in 40 years. The government can't bail everyone out because it's already drowning in a staggering $36 trillion of debt. Let me walk you through the reasons why every major financial indicator is screaming red alert. I'm going to explain why the window for this crash is between November 2025 and June 2026, and why this impending collapse is poised to wipe out more wealth than any other event in human history. This isn't just speculation or fear-mongering. This is based on cold, hard mathematics. To truly grasp why 2025 is unlike any previous crash, you need to understand that we're not dealing with just one bubble. We're facing three simultaneous bubbles that have never before occurred together in financial history. Let's start with the stock market. The S&P 500 is currently trading at a price-to-earnings ratio of 28, nearly double the historical average of 15 to 17. This level of extreme overvaluation has only been seen twice before, in 1929, right before the Great Depression, and in 2000, right before the dot-com crash that vaporized 78% of the Nasdaq's value. Both times, the market imploded within months of reaching these dangerous extremes. But the concentration risk we face in 2025 makes the situation even more precarious than in 1929 or 2000. Just 7 stocks, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, account for roughly 30% of the entire S&P 500's total market value. Think about that for a moment. If these 7 companies stumble, they will drag the entire market down with them. Such extreme concentration hasn't been seen since 1929, when a small handful of industrial stocks propped up the entire market right before the bottom fell out. In 2000, the dot-com bubble was heavily concentrated in technology stocks, but they still represented a smaller piece of the overall market pie. Today's concentration is more extreme, more dangerous, and more fragile. Nvidia alone perfectly illustrates the insanity of current valuations. The company is trading at a price-to-earnings ratio above 65, meaning investors are shelling out $65 for every single dollar of profit the company generates. Nvidia's total market value has surged past $3 trillion, making it worth more than the entire German stock market, which is the 4th largest economy in the world. This isn't rational investment. This is pure speculation fueled by artificial intelligence hype that mirrors the internet frenzy of 1999. Everyone is convinced that AI will revolutionize everything, just like everyone was convinced that the internet would change everything back in 1999. They were ultimately proven right about the internet's long-term impact, but they were catastrophically wrong about short-term stock valuations. The same exact scenario is unfolding right now with AI. The second bubble is in real estate, and it's actually more overvalued than the 2008 housing bubble that nearly brought down the entire global financial system. As of November 2025, home prices are roughly 50% above their long-term historical trend relative to income and rent. At the peak of the 2008 bubble, homes were 35% above trend. This means the current housing bubble is a staggering 43% larger than the one that triggered the Great Recession. Let that sink in for a moment. The crisis that required trillions in bailouts and almost destroyed capitalism itself was based on a 35% overvaluation. We're now at 50% overvaluation. And what's even more concerning is that most people don't even realize we're in a bubble because prices have been artificially inflated for so long that it feels normal. But residential real estate is only part of the problem. Commercial real estate is currently in freefall, creating a slow-motion disaster that will accelerate through 2025 and 2026. Office buildings across America are sitting 45% vacant as remote work becomes a permanent fixture. San Francisco, for example, has a 35% vacancy rate in commercial office space. These buildings were originally financed with mortgages when interest rates were around 3%. Now, those mortgages are coming due and need to be refinanced at rates of 7 to 9%. The buildings simply aren't worth enough to support the new debt service at triple the interest rate. This will inevitably lead to defaults, massive bank losses, and a cascade of failures that will mirror the 2008 subprime crisis, except this time it will be in commercial properties instead of residential. The third bubble, and this is what makes 2025 an unprecedented situation, is the bond market. Government bonds are traditionally considered the safe haven you turn to when stocks crash. In 1929, bonds remained relatively safe even as stocks collapsed by 89%. In 2008, Treasury bonds rallied as investors frantically fled stocks in search of safety. But in 2025, bonds are crashing right alongside stocks because the U.S. government has issued so much debt that the bond market simply can't absorb it anymore. Total federal debt has ballooned to over $36 trillion, roughly 125% of GDP. This is the same debt-to-GDP ratio America had at the end of World War II. However, after World War II, America was the only major economy that hadn't been decimated by the war. Today, America is competing with countries that have lower debt and stronger economic fundamentals. The annual interest payment on this massive debt now exceeds $1.2 trillion per year, making it the single largest line item in the federal budget, dwarfing even defense spending and Social Security. When interest payments become the single biggest expense, the government is left with three terrible choices: drastically cut spending and trigger a recession, drastically raise taxes and trigger a recession, or print money to pay the debt and cause hyperinflation. All three options lead to economic catastrophe. There is no easy way out when your interest payments alone are equal to the GDP of Mexico. This, in a nutshell, is the everything bubble. Stocks overvalued to levels only seen twice before, both times right before crashes, real estate more overvalued than in 2008, and bonds, the traditional safe haven, crashing under the immense weight of unpayable government debt. The parallels between 2025 and 1929 are so strikingly similar that it's like watching history replay itself frame by frame. In 1929, stock valuations reached levels that had never been seen before. The price-to-earnings ratio of the Dow Jones Industrial Average hit 33, far exceeding any historical precedent. In 2025, we're seeing similar extremes, with the S&P 500 trading at 28 times earnings. In 1929, the public was convinced that new technology, specifically electricity, the radio, and the automobile, had ushered in a new permanent economy where old valuation rules no longer applied. "This time is different," was the mantra constantly repeated in 1929. In 2025, artificial intelligence is the new technology that supposedly makes old rules obsolete. In 1929, margin debt, money borrowed to buy stocks, reached record levels as everyone from doctors to shoeshine boys leveraged themselves to participate in the booming market. Stories circulated about ordinary people becoming rich overnight through stock speculation. In 2025, margin debt as a percentage of GDP is at similar extremes, but modern leverage extends far beyond traditional margin accounts. Options trading by retail investors has exploded. People are using credit cards to buy stocks. Companies are borrowing money to buy back their own shares at inflated prices. The leverage in the system is everywhere, hidden in derivatives, complex options, and debt structures that most people don't even understand. Wealth inequality in 1929 had reached extreme levels, with the top 1% controlling roughly 25% of total income. This concentration meant that the economy was heavily dependent on a small number of wealthy individuals continuing to spend and invest. When they stopped, the entire system collapsed. In 2025, wealth inequality has reached even higher levels. The top 1% controls approximately 32% of total wealth, surpassing even 1929. The economy is now heavily reliant on the top 10%, who control 70% of consumer spending. If the wealthy stop spending because their stock portfolios crash, consumer demand will evaporate and the economy will collapse. But here's the chilling reality: 2025 is actually worse than 1929. In 1929, most Americans weren't invested in the stock market. Only about 10% of households own stocks, which means 90% of the population wasn't directly affected by the initial stock crash. They suffered later through unemployment and deflation, but the initial crash didn't wipe out their savings because they didn't have savings in stocks. In 2025, approximately 58% of American households own stocks, either directly or through retirement accounts like 401(k), and IRAs. This means that when the market crashes, it will directly destroy the retirement savings of more than half the country. There's no insulation, no buffer. Everyone will suffer immediately. The banking sector in 1929 was fragmented across thousands of small banks with no federal insurance. When the crash came, banks failed because depositors panicked and withdrew their money. The lack of deposit insurance meant that bank failures wiped out ordinary people's savings. In 2025, we have FDIC insurance that supposedly protects deposits up to $250,000. But the FDIC has only about $125 billion in its fund while insuring approximately $10 trillion in deposits. If multiple large banks fail simultaneously, the FDIC fund will be laughably insufficient. The government would then have to print trillions to make depositors whole, which would destroy the currency through hyperinflation. Either depositors lose their money through bank failures, or they lose their money through hyperinflation. It's a lose-lose scenario. Pick your poison. The Federal Reserve in 1929 had credibility and room to act. They had only been established in 1913, just 16 years earlier, and hadn't yet destroyed public confidence through decades of boom and bust cycles. They could have cut interest rates more aggressively, but they didn't fully understand what they needed to do until it was too late. In 2025, the Federal Reserve has spent the last 15 years proving it can't effectively manage the economy. They inflated a massive bubble through quantitative easing after 2008. They kept interest rates artificially low for far too long, creating the everything bubble. Then, they raised rates too aggressively in 2022 and 2023, causing inflation while simultaneously threatening to crash the economy. The Fed has lost credibility. More importantly, they've lost the tools to fix the next crisis. The 2008 financial crisis provides an even more recent and relevant comparison to what's coming in 2025 and 2026. In 2008, the crisis began with subprime mortgages, loans given to people who couldn't afford them. These mortgages were then packaged into complex securities and sold to investors worldwide. When housing prices stopped rising, borrowers couldn't refinance and started defaulting. The defaults cascaded through the financial system, revealing that banks were massively overleveraged and holding worthless mortgage-backed securities. In 2025, subprime lending exists everywhere, except we don't call it subprime. We have auto loans with 84-month terms at high interest rates to people with poor credit. Credit card debt is at record levels with average interest rates exceeding 21%. Student loans total $1.77 trillion, and many will never be fully repaid. Corporate debt has quintupled from $2 trillion in 2008 to over $10 trillion today as companies borrowed at low rates to buy back their own stock. The leverage in the system in 2008 was primarily concentrated in housing and mortgage-backed securities. Banks like Lehman Brothers were leveraged 30 to 1, meaning they had $30 of assets for every $1 of capital. When those assets declined by even 3%, the bank was wiped out. Lehman collapsed in September 2008, triggering the worst financial panic since the Great Depression. In 2025, leverage isn't concentrated in one sector. It's everywhere. The derivatives market now exceeds $600 trillion in notional value, 10 times global GDP. Most of these derivatives are interest rate swaps and credit default swaps that would explode if either interest rates move dramatically or if major corporate defaults begin. This interconnectedness means one failure triggers others, which trigger others in a cascade that can't be stopped. In 2008, the Federal Reserve had powerful tools to address the crisis. Interest rates were at 5.25% when the crisis began, giving the Fed plenty of room to cut all the way to zero. This stimulated borrowing and spending, helping to stabilize the economy. The Fed could also implement quantitative easing, buying trillions in treasury bonds and mortgage-backed securities to inject money into the financial system. The Fed's balance sheet went from $800 billion before the crisis to $4 trillion by 2014. This unprecedented money printing helped avert a complete collapse, but it created the bubbles we're dealing with now. In 2025, interest rates are already relatively low, giving the Fed minimal room to cut. If they cut rates dramatically, they risk reigniting the inflation that just required painful rate hikes to bring under control. If they don't cut, they risk letting the economy crash into a depression. Quantitative easing is similarly constrained in 2025. The Fed's balance sheet is already over $7 trillion after multiple rounds of QE following 2008 and again during COVID. They can print more money, but everyone now understands that printing money causes inflation. The 2021 to 2023 inflation surge, the worst in 40 years, proved that you can't print unlimited amounts without destroying the currency's purchasing power. The Fed is trapped. They can print money and destroy the dollar through inflation, or they can refuse to print money and let deflation create another Great Depression. There's no good option because the tools that worked in 2008 don't work anymore after being overused. The government bailout capacity is also exhausted. In 2008, the government could borrow to bail out banks because federal debt was about 67% of GDP, which was manageable by historical standards. The Troubled Asset Relief Program, TARP, authorized $700 billion to buy toxic assets from banks. Additional programs brought the total bailout close to $2 trillion. This was politically unpopular but economically feasible because the government had borrowing capacity. In 2025, federal debt is 125% of GDP with trillion-dollar deficits as far as the eye can see. The government simply doesn't have another $2 trillion to bail out failing banks and corporations. If they try to borrow it, bond markets will revolt, and interest rates will spike even higher, making the debt service even more unsustainable. The bailout option that saved the system in 2008 simply doesn't exist in 2025. The international dimension also makes 2025 worse than 2008. In 2008, China was booming and helped pull the global economy out of recession by stimulating domestic demand and buying commodities. Europe, while affected by the crisis, wasn't in the same debt trap as the United States. Global cooperation through the G20 coordinated stimulus efforts. In 2025, China is experiencing its own economic crisis with a collapsing real estate sector, local government debt exceeding $13 trillion, and a demographic crisis as its population shrinks. Europe is dealing with an energy crisis, demographic decline, and political fragmentation. There's no major economy in a position to lead a global recovery. Geopolitical tensions mean cooperation is unlikely. When the crisis hits, every country will be fighting for its own survival rather than coordinating solutions. The most reliable predictor of recessions over the last 70 years has been the inverted yield curve. When short-term interest rates exceed long-term rates, this has predicted every recession since 1950 with no false positives. The yield curve inverted in July 2022 and remained inverted for 27 months, finally normalizing in September 2024. Historical analysis shows that recessions typically begin 3 to 12 months after the yield curve returns to normal, not while it's inverted. This means the danger window is October 2024 through September 2025. We're in that window right now. The signal that has never been wrong is telling us that a recession is imminent. Consumer debt has reached levels that make the 2008 crisis look manageable by comparison. Credit card debt exceeds $14 trillion, an all-time record in nominal terms. The average credit card balance is $6,800 per household with interest rates averaging 21 to 28%. Credit card delinquencies, the percentage of borrowers 90 days or more behind on payments, have risen to levels not seen since 2011. This matters because consumer spending represents 68% of the U.S. economy. When consumers can't borrow anymore and have to start paying down debt instead of spending, the economy contracts. We're at the point where consumers are maxed out. They can't keep the spending going that the economy requires. The commercial real estate crisis is unfolding in slow motion but will accelerate dramatically through 2025 and 2026. Over $2 trillion in commercial mortgages come due during this period and must be refinanced. These properties were financed when interest rates were 3%. Today's rates are 7 to 9%. A building that barely cash flowed at 3% interest is bankrupt at 8% interest. The math doesn't work. Building values have dropped 40 to 60% in many markets because buyers understand the properties can't support the debt at current rates. When these mortgages can't be refinanced, the owners will default and hand the keys to the lender. Regional banks holding these mortgages will realize massive losses that wipe out their capital. The regional bank failures in 2023 were a warning that few people heeded. Silicon Valley Bank collapsed in March 2023 in the second-largest bank failure in U.S. history. Signature Bank failed the same week. First Republic Bank failed in May 2023 and was absorbed by J.P. Morgan at a massive loss covered by the FDIC. New York Community Bank teetered on the edge of collapse in January 2024. These failures occurred even though we weren't in a recession. When the recession hits and loan defaults surge, dozens more regional banks will fail. The FDIC will run through its $125 billion insurance fund within weeks. The government will then have to print money to cover deposits, destroying the currency's value. The concentration of market value in 7 stocks, the so-called Magnificent Seven, creates a fragility that didn't exist in previous eras. Apple, Microsoft, Nvidia, Amazon, Google, parent Alphabet, Meta, and Tesla represent 30% of the S&P 500's total market capitalization. Nvidia alone, with its price-to-earnings ratio above 65, accounts for approximately 7% of the entire index. If Nvidia's earnings disappoint or if AI hype fades, the stock could easily drop 50 to 70%. That single stock declining would take the entire market down with it. This concentration risk is unprecedented. When the market crashes, these 7 stocks will lead the decline. And because there's such a large percentage of the index, the crash will be faster and more severe than anything we've seen. Insider selling has reached levels that historically precede major market declines. Corporate executives have access to information that ordinary investors don't. They see the real earnings, the real pipeline, and the real problems before anyone else. When they start selling massive amounts of their own company's stock, it's a signal that they don't believe current prices are sustainable. Jeff Bezos sold over $13 billion worth of Amazon stock through 2024 and 2025. Mark Zuckerberg has been selling billions worth of Meta stock. Nvidia executives, even as the stock was hitting new highs, were selling shares. This is what happened in 1929 and again in 2000. Insiders know when valuations are insane, and they get out before the crash. Or consider Warren Buffett, the most successful investor in history, who is hoarding cash at levels he's never maintained before. Berkshire Hathaway's cash position exceeds $325 billion, the highest in the company's history, both in absolute terms and as a percentage of assets. Buffett has been selling stocks, including reducing his massive Apple position and buying treasury bills. When asked why, he cited valuations being too high and being unable to find attractive investments. Buffett's own metric, the Buffett indicator, which divides total stock market value by GDP, sits at 185%. He has said that a reading above 120% indicates dangerous overvaluation. At 185%, the signal couldn't be clearer. The world's best investor is sitting in cash, waiting for the crash because he knows it's coming. Unemployment has started rising from a 3.4% low in early 2023 to 4.1% by October 2025. While 4.1% is still historically low, the direction of change matters more than the absolute level. The Somme rule, developed by economist Claudia Somme, states that when the 3-month moving average of the unemployment rate rises 0.5 percentage points above its low of the prior 12 months, the economy is in a recession. This rule has predicted every recession since 1970 with no false positives. As of October 2025, we're at or near the threshold that triggers the Somme rule. The unemployment trend is rising, and once it starts rising, it accelerates as layoffs trigger more layoffs. Auto loan delinquencies have spiked to levels not seen since the 2008 financial crisis. Approximately 7.5% of auto loans are 90 days or more past due, the highest rate since 2009. Average monthly payments on new car loans exceed $740, and loan terms have stretched to 84 months, 7 full years of payments. This is subprime lending disguised with different terminology. People who can't afford cars are being given loans they can't repay. When they default, it affects not just the lender but their ability to get to work, creating a cascade where job loss follows auto repossession. This is a leading indicator of broader financial stress in the consumer sector. Student loan delinquency rates have surged since payments resumed in October 2023 after a 3-year pandemic pause. Total student debt stands at $1.77 trillion across 43 million borrowers. Many are choosing to default rather than resume payments, understanding that the debt is so large they'll never pay it off anyway. This drains $100 billion or more per year from the economy as young people service debt instead of buying homes, starting families, or spending on goods and services. The generation that should be driving economic growth is instead drowning in debt that offers no economic return. Geopolitical risks in 2025 include ongoing wars in Ukraine and the Middle East, the constant threat of China invading Taiwan, and the fragmentation of global trade into rival blocs. Any of these situations could escalate into conflicts that disrupt energy supplies, food supplies, or critical supply chains. An oil price shock similar to the 1970s would trigger stagflation, the combination of inflation and recession that's even more difficult to manage than recession alone. Markets hate uncertainty, and geopolitical uncertainty in 2025 is as high as at any point since the 1970s. Commercial real estate defaults are already beginning at major institutional owners. Brookfield Asset Management defaulted on 2 Los Angeles office towers in 2024. Blackstone, the world's largest commercial real estate owner, has struggled with redemption requests from investors wanting their money back. These are the sophisticated players, the smart money, walking away from properties because the math doesn't work at current interest rates. When the major players start defaulting, it signals that the fundamentals have broken. The defaults will cascade through 2025 and 2026 as more mortgages come due, triggering bank losses, more defaults, and eventual bank failures. The crash won't announce itself with a clear starting point that everyone recognizes. It will begin with something that seems manageable: an earnings miss by a major tech company, a larger-than-expected regional bank failure, an escalation in a geopolitical conflict, or a breakdown in debt ceiling negotiations. The trigger itself almost doesn't matter because the system is so fragile that any shock will start the cascade. What matters is what happens next, how one failure triggers another, which triggers another, until the entire financial system is in freefall. When Nvidia or another Magnificent Seven stock misses earnings projections or provides weak forward guidance, algorithmic trading systems will start selling instantly. The stock could drop 10 to 15% in a single day. Because Nvidia represents 7% of the S&P 500, that alone would take the index down 0. But the real damage will come from the psychological impact. If the AI story that has driven valuations starts to crack, investors will question all tech valuations. Microsoft, Apple, Amazon, Google, Meta, and Tesla would all sell off in sympathy. Within days, the so-called Magnificent Seven tech stocks could plummet by 20 to 30%, dragging the entire stock market down with them by 6 to 9%. This sharp decline will then set off a chain reaction of margin calls. Margin calls are essentially fuel on the fire, turning what might have been a manageable downturn into a full-blown crash. This happens because investors often borrow money to purchase stocks, and when those stocks lose value, their brokers demand that they put up additional collateral to cover the losses. If the investor doesn't have the cash to provide, the broker is forced to sell the stocks to recoup the loan. This forced selling then drives the prices of those stocks even lower, triggering even more margin calls and subsequent forced selling, creating a vicious cycle. Back in 1929, margin calls were a major factor in creating a downward spiral that proved to be impossible to stop. Fast forward to 2025, and the level of margin debt as a percentage of the overall market value is alarmingly similar to what it was in 1929, which is a major cause for concern. When the selling pressure really kicks in, it's going to be incredibly swift and relentless. Institutional investors, who are responsible for managing trillions of dollars in pension funds, endowments, and sovereign wealth funds, operate under strict risk management rules. These rules mandate that they automatically sell off assets when the market drops beyond certain predetermined thresholds. These aren't emotional, spur-of-the-moment decisions. They're entirely automated processes driven by sophisticated algorithms. So, when stocks fall by, say, 20%, these risk management systems will trigger widespread selling to try to prevent any further losses. This massive institutional selling only amplifies the existing downward pressure on the market. Within just the first month of the crash, stock prices could easily plummet by 30 to 40% as panicked retail investors, margin calls, and automated institutional risk management systems all contribute to driving prices down simultaneously. This economic cascade will then spread from the stock market to the bond market as investors desperately try to find what they believe is a safe haven for their money. However, in 2025, Treasury bonds are far from a safe bet because the government will need to issue trillions of dollars worth of new bonds to cover its existing budget deficits and refinance maturing debt. If there's a massive flight to safety at the same time that the government is trying to flood the market with new bonds, interest rates are inevitably going to spike even higher. This creates a devastating doom loop for the economy. Higher interest rates increase the government's debt service costs, which then requires even more borrowing. To finance this increased borrowing, the government has to issue yet more bonds, which in turn drives interest rates even higher. Countries caught in this kind of financial death spiral typically end up facing either a sovereign debt default or a collapse of their currency through runaway inflation. The housing market will essentially freeze solid as potential buyers vanish and sellers are unwilling to accept lower prices for their homes. Homes will sit on the market for months and months without receiving a single offer. People who absolutely need to sell, because of job relocations or pressing financial difficulties, will eventually start slashing their prices. These price cuts will then establish new, lower comparable sales values, which will drive down home values across the board. Within just 6 months, home prices could easily be down 20 to 30% from their peak. Within a year, declines of 40 to 50% are a very real possibility in previously overvalued markets like Austin, Phoenix, Boise, and certain parts of California and Florida. Homeowners who bought their properties within the last 3 years will suddenly find themselves underwater on their mortgages, owing more to the bank than their homes are actually worth. Defaults on commercial real estate loans will accelerate rapidly as property owners realize they simply can't refinance their maturing mortgages. They'll stop making payments and simply hand the keys back to the lender. The lender, which is typically a regional bank, will then take possession of a property that's worth 40 to 60% less than the outstanding loan amount. This is what's known as a realized loss. When banks realize massive losses on their commercial real estate loan portfolios, it completely wipes out their capital reserves. Banks are legally required to maintain minimum capital ratios as a safeguard. When those ratios fall below the levels required by regulators, the regulators will step in and shut the bank down. In the financial crisis of 2008, a staggering 465 banks failed over a period of 5 years. In the coming crisis, we could easily see similar or even higher numbers of bank failures, but concentrated in a much shorter period of time. These bank failures will create widespread panic that spreads like wildfire to banks that are actually solvent and in good financial health. Depositors will see banks collapsing and will rush to withdraw their money from any bank that they perceive to be even remotely risky. This will create a classic bank run scenario. Even healthy banks don't have enough cash on hand to pay out all of their depositors simultaneously because they've lent that money out or invested it in securities. When a bank run starts, the bank is forced to sell off its assets at fire sale prices to raise cash to meet the demands of depositors. Selling assets at deeply discounted prices creates huge losses that can quickly turn a healthy bank insolvent. The Federal Deposit Insurance Corporation, FDIC, steps in to guarantee deposits, But the insurance fund, which currently stands at around $125 billion, is woefully inadequate to cover the failure of multiple large banks. The government will then have to print massive amounts of new money to cover the insured deposits, which will kickstart the inflation process that will ultimately destroy the value of the currency. Employment will collapse as companies facing declining revenues cut costs by laying off workers. Tech companies that grew bloated during the boom years will start laying off 10 to 20% of their workforces. Finance companies that are heavily exposed to the market declines will cut staff drastically. Consumer discretionary companies, facing a situation where customers simply can't afford to spend money, will close stores and eliminate positions. Within just 3 months of the crash starting, the unemployment rate could rise from its current level of around 4% to 7 or 8%. Within 6 months, an unemployment rate of 10% is a very realistic possibility. Within a year, 12 to 15% unemployment is likely as the cascading failures ripple throughout the entire economy. The Federal Reserve will face an impossible choice. They can cut interest rates and implement quantitative easing to try to stabilize the markets. But doing so risks reigniting inflation before it's fully been brought under control. Everyone vividly remembers the period from 2021 to 2023 when inflation soared to 9% and decimated people's purchasing power. If the Fed starts printing trillions of dollars again, the dollar will collapse and inflation will return even worse than before. Or the Fed can simply let the crash play out, which means depression-level unemployment and a decade of economic stagnation. There is no middle ground or easy solution.